If you just glance at the Q1 exit volume, you'd think private equity is doing fine.
Only if you ignore the $29 billion Restaurant Depot deal. Leonard Green literally saved the entire quarter.
A win is a win. You can't just strip out the biggest transaction to force a doom narrative.
I can when sponsors are secretly blaming artificial intelligence for why they can't cash out.
Wait, they're blaming AI? That is a beautifully desperate excuse.
Oh, it gets better. Let's look at who is actually managing to exit right now, starting with Blackstone's new billion-dollar hotel bill. The rundown.
You strip out Leonard Green's $29 billion Jetro Restaurant Depot deal, and Q1 private equity exits look like an absolute ghost town.
Completely barren. But I love the excuses we're hearing from sponsors right now. They're literally blaming artificial intelligence and ongoing wars for the sales slump.
Well, geopolitical conflict does break down deal pipelines. That's a real stress fracture.
Oh, come on, Nate. You know as well as I do that AI is just the new supply chain issues. It's the perfect corporate scapegoat. We can't return capital to our LPs because ChatGPT is disrupting our portfolio, please.
Spoken like a true tech cynic. But look, buyers are spooked. The macro environment is objectively messy.
They're just holding on to assets they overpaid for in 2021. The Jetro deal was a massive outlier that saved the industry's quarterly stats. Period.
Fair point. Let's look at what is actually moving. Accor just signed an MOU to sell its stake in Essendi to a Blackstone-led group.
For up to $1.1 billion.
You always catch the up to.
I have to. It means Blackstone baked in an earnout or some performance hurdles. I want to see the definitive agreement before I give them credit for $1 billion exit.
We'll keep an eye on it. It's still just a memorandum of understanding right now.
Speaking of creative structures, Verda Partners just led a massive $1.7 billion significant risk transfer with Klarna.
Now that is banker catnip right there. A synthetic securitization to free up capital. Klarna gets to keep lending. Verdi takes the risk for a premium yield.
Exactly. It's a huge number for a European fintech risk transfer. Klarna is aggressively cleaning up its balance sheet.
Getting ready for an IPO, maybe?
You know, I won't speculate on a Klarna IPO until I see an S1.
Boring. Okay, rapid fire on the rest. Merit Medical is buying Viewpoint Medical for $140 million.
Smart tuck-in. Viewpoint does imaging. Merit just plugs them right into their existing sales channels.
And Antin Infrastructure's Fund V is taking Sapphire Gas Solutions off Apollo's hands. Compressed natural gas is having a weirdly strong moment.
Plus, Lupin grabbed Visu Pharma to expand their European ophthalmology footprint. Just solid, quiet, strategic M&A while private equity cries about AI.
You really aren't going to let the AI excuse go, are you?
Never. But speaking of mega deals that actually closed, we need to unpack exactly how Leonard Green pulled off that $29 billion Restaurant Depot Lifeline.
Grab your aprons. We're going bulk shopping right after this. The big one. You look at the Q1 exit volume on paper and you think, okay, private equity is back. The machine is humming.
The machine is gasping for air, Nate. It is literally one giant $29 billion oxygen tank holding up the entire quarter.
Okay, fair. Leonard Green and partners completely warped the curve here.
Warped is an understatement. If you strip out their sale of Jetro Restaurant Depot, the Q1 private equity exit numbers look like an absolute horror movie. It is a complete slump.
Look, 29 billion is 29 billion. You do not get to just asterisk a transaction that size because it ruins your bear thesis. Leonard Green pulled off a monster exit in a terrible market, selling a restaurant wholesale supplier for almost $30 billion right now. We should be popping champagne for them. That is a massive win.
I am not taking away from the Jetro deal. It is a fantastic outcome for Leonard Green. But you cannot tell me the broader private equity landscape is healthy. I read the footnotes on these quarterly reports. When you remove that single outlier, distributions to limited partners are basically flatlining.
The LPs are definitely getting restless. I was talking to a sponsor last week who looked like he had not slept since November. They are sweating over this exit slump, Maya, and they are blaming absolutely everything. Geopolitics, interest rates, and my personal favorite, AI disruptions.
Oh my God, the AI excuse. I cannot handle it anymore.
It is the perfect banker scapegoat. If your portfolio company misses earnings, just tell the investment committee that artificial intelligence disrupted your total addressable market. No one can prove you wrong.
It is pure corporate theater. You overpaid for a mediocre enterprise software company at 20 times revenue in 2021, Nate. ChatGPT did not ruin your multiple. Your completely delusional underwriting ruined your multiple.
Okay, ouch. But fair. Still, if you are a fund manager right now, the pressure to return capital is astronomical. You cannot survive on paper markups forever.
Exactly. Which is why they are desperately pointing to Jetro to pad their quarterly stats. But analysts are openly talking about severe stress fractures in the landscape. Traditional deal pipelines are just broken.
So what happens in Q2 when we do not have a wholesale cash and carry giant to save the math?
The mid-market actually has to start clearing. We need to see regular billion-dollar exits actually close, not just rare mega deals.
Speaking of billion-dollar exits trying to close, Accor just signed a memorandum of understanding to sell its stake in Essendi.
Right, to a Blackstone-led consortium, up to $1.1 billion. But an MOU is not a closed deal. I want to see the definitive agreement.
We are definitely watching that one tomorrow, along with Merit Medical dropping $140 million for Viewpoint Medical.
I already pulled the early filings on Merit. The imaging technology is smart, but I have some serious questions about how they plan to integrate it. Voices.
The Financial Post had this piece this morning claiming artificial intelligence and global conflicts are creating quote-unquote severe stress fractures in the PE pipeline.
I saw that, and I rolled my eyes so hard I almost pulled a muscle.
Wait, you don't buy the geopolitical angle?
I think blaming AI and wars for your exit slump is a very convenient way to avoid talking about the fact that you overpaid for assets in 2021, and now the math doesn't work.
Okay, fair. The valuation hangover is real. But the exit slump itself is very real too. Sponsors are sweating behind closed doors. You have fund managers absolutely desperate to return capital to LPs right now, and the traditional pipelines are just clogged.
They are, which is why the Q1 numbers are completely hilarious if you actually look at the composition. The headline exit volume looks fine, but market watchers are pointing out it is entirely propped up by one deal.
The Restaurant Depot deal.
Exactly. Leonard Green and Partners selling Jetro Restaurant Depot. Over $29 billion. If you pull that single transaction out of the dataset, the Q1 private equity exit chart looks like a cliff.
29 billion. That is the ultimate banker move. Just find one massive outlier to pad the quarterly stats and tell your LPs the ecosystem is healthy. We used to call that the whale in the wading pool.
It completely skews the reality on the ground. You cannot rely on a $29 billion wholesale food distributor to hide the fact that standard exits are frozen.
No, you cannot, but you know who isn't frozen? Blackstone.
They never are.
Accor just signed a memorandum of understanding to sell its stake in Essendi to a Blackstone-led group, up to $1.1 billion.
We need to watch how that definitive agreement shapes up tomorrow, along with Merit Medical buying Viewpoint Medical for $140 million.
Speaking of Merit Medical, did you look at the integration timeline they filed? Spill the tea. I'm hearing so much whining from PE sponsors right now. Behind closed doors, they're absolutely sweating this exit slump.
Oh, my heart bleeds for them. What's the official excuse this quarter?
It's a combination platter. They're blaming global conflicts, which, fair enough. But the new one I keep hearing is AI disruption. They're saying AI is breaking down traditional deal pipelines.
Wait, really? AI disruption? That's the most pathetic scapegoat I've heard all year. You can't just sprinkle artificial intelligence on a bad quarter and hope your LPs look the other way.
Hey, as a former banker, I respect the hustle. If you can't return capital, you have to build a narrative.
But the narrative falls apart if you actually read the Q1 exit volumes. The entire industry is hiding behind Leonard Green and Partners.
The Jetro Restaurant Depot deal.
Exactly. $29 billion. If you pull that one massive outlier out of the data, the Q1 stats look like a horror movie. Fund managers are just using it to pad their numbers.
I disagree, actually. I mean, yes, Leonard Green saved the quarter, but the stress fractures from AI and macro instability are real. If you're trying to value a software target right now, how do you model the risk that an AI startup eats their core product in 6 months?
You price it in. You don't just stop doing deals and cry to the Financial Post about it.
Spoken like a true spreadsheet warrior. I used to write those exact macro headwind excuses into pitch decks, Maya. It's an art form.
It's corporate theater. Speaking of things that aren't quite real yet, we need to talk about Accor.
The Blackstone consortium. $1.1 billion for the Essendi stake.
Right, but it's just a memorandum of understanding right now. I want to see if it actually progresses to a definitive agreement tomorrow, along with Merit Medical's $140 million play for Viewpoint.
We'll be tracking both. Let me just ask ChatGPT how to value them first. Tomorrow's radar. I'm keeping my eyes glued to this Accor and Blackstone MOU tomorrow. $1.1 billion for the Essendi stake. I want to see them lock down the definitive agreement.
It's a memorandum of understanding, Nate. A glorified pinky promise. I'm not putting this on my tracker until the ink is dry.
Oh, come on. Blackstone doesn't do billion-dollar pinky promises.
We'll see. I'm actually watching for Merit Medical's regulatory filings tomorrow. They just dropped that $140 million Viewpoint Medical acquisition.
That's a rounding error compared to Accor?
Maybe, but it's a real deal. Meanwhile, PE sponsors are sweating bullets in secret because their exit pipelines are completely fractured.
Hey, Leonard Green just got the $29 billion Jetro exit done.
Which single-handedly masked a disastrous quarter. Take out Jetro and the data is brutal. LPs are tired of hearing about AI disruptions and global conflicts. They just want cash.
We'll see if Blackstone brings them some tomorrow. Catch you next time, Deal Street.